One of the things that, in addition to just putting strong consumer protections in place, is to keep our program flexible and responsive. Responsive to the real estate market, responsive to consumers, responsive to legislative changes. And so I don't know that I can give you a specific answer on that because it would probably depend on the circumstances. But I can tell you that we remain vigilant. So, and we maintain a dialogue with our program participants. So, for example, once the financing is complete, it could be almost a year before that property tax bill comes out with that. So they could go through actually 2 payment periods before that payment is on their bill. We are checking those to see if they are still current, even though the lien has not appeared on their bill. So we are talking to them right after, if they haven't paid, we're talking to them within 30 days of them missing a payment. If they are headed towards a default at the end of the fiscal year, we're talking to them. We're also talking to their lender. So we're making an attempt to work with them to get that paid before it becomes a more difficult situation. We also, once after the fiscal year elapses, we can strip that lien off of the property tax roll for separate payment if it makes it easier for them. It means the rest of the taxes will toll, but that's another smaller payment. So we try to stay vigilant and work with the property tax owner if they are struggling. Currently, we don't have any defaults. We haven't had any foreclosures, and we have a small, I think it's 8 out of 2,000 taxpayers that are only missed their last installment.
I know we're running short in time, but I will love to get one quick follow-up if the chair will let me. Do you think that all those really impressive statistics you just read, and I applaud you for the work on this, because I think your dedication is clear to make sure that consumers are always paramount in what is happening within your program. Do you think that would be the case or the reality had you contracted out with a third-party for-profit company?
You're asking me to speculate, and you're asking me to speculate in a way that really has to do with would we have made a decision to provide, what level of oversight would we have made a decision to provide? I can tell you that a lot of the reason that we did this is because we had the in-house expertise. Yeah. I
appreciate it. Thank you.
To do that.
For some of these reasons is why you don't offer any.
Pardon me?
And this is why you don't offer any of the my mouth is always stumbles over that. Subordinated loans. Subordinated.
Yes,
right?
Because we feel that it's bad public policy from a tax collector standpoint. It's bad public policy not to if you contractually arrange to not foreclose, you've taken away your own leverage. So you can use that to keep pressure. I've been tax collector since 1993. I hold a tax default tax auction every year. I've not sold anyone's homes. We find ways. We know we have the tools and know how to apply the leverage and work with the property tax payers to have the best possible outcome.
Thank you.
You had asked a question, Chairwoman Eggman, about the multiple liens, and I don't think it got answered. So if
please, thank you.
Multiple liens are allowable. However, they still must meet the criteria. So while they, if you were to take out one lien and do, let's say, an HVAC system and a solar system on one application resulting in one lien, you have to meet all of the underwriting criteria. If you were to do the HVAC system on one application that resulted in a lien and you came back and wanted to do the solar system, you could do that as long as you met all of the qualifications still, and the prior lien would be included in those qualifications.
So it wouldn't be a separate.
It would be a separate lien.
So it would be a separate lien, yes.
But the payment would be at the same place.
It would, being a separate lane, it would show up as two line items, yes.
Okay. Any other questions?
Can I just ask one question? What's the difference in these programs for people who really own their home, senior citizens, and they don't have the money to pay that tax when it comes due? Is there something for them that's different? Is there a program where they don't have to pay?
No, currently the ability to defer the program is unavailable, and more disconcerting to me as a tax collector is the ability of something that you collectively have voted on to bring back as a property tax postponement program for our senior citizens, blind and disabled. They would be precluded from participating in that program currently, so our most vulnerable is potentially at risk. So excellent question, but currently there is no provision that would allow for that.
But there are provisions that allow for seniors to be able to remain in their home if they can't meet their traditional property tax burdens.
Now that the PTP is brought back, if they qualify for that program and enroll, given that there is funding, that's the limitation now than previously. There was a provision to help pay for those taxes, similar to there are banking means as well, reverse mortgages and such products.
Would someone still be eligible to have that part of their property tax paid for in a program like that with a super lien, or would they be completely disqualified because of how does the super lien?
So the super lien status is part of that, but Janine and Placer, by removing it from the tax roll, that would allow them to re-enter to, provided they still make the equity requirements, but otherwise they would be prevented unless that can be removed.
Right. And again, that goes to the disclosure and the consumer protection that you would have to do on the front end.
Right. If we saw somebody who was part of that program, I think that would disqualify them from participating in the PACE program. The other thing that after property taxes have defaulted, that is the turn of the fiscal year is what changes the status from a delinquency to default. Property owners are eligible for payment plans. It's 20% down of the aggregate amount that needs to be paid, including aggregate amount includes multiple years, and then they have to pay 20% every subsequent fiscal year. The PACE lien can be included on that unless the PACE lien provider strips it off. It will be included in that.
I would just, as one final thought before we go to the next panel, which I know we're running over for, I would say maybe, I know the representative from CAFE is still here, maybe we look at the last reserve program as an opportunity to maybe, if we had a situation where seniors were put in a position where they, unfortunately, something happened, they could not pay that tax liability, and they didn't have a treasurer tax collector as thoughtful and qualified as you, that we would have some kind of help provided through that. Since I've been told that nothing's come out of that program, that'd be a good way to use that money to maybe help some seniors stay in their home that did the right thing and wanted to be more energy efficient. Thank you so much.
Thank you to the panel. Thank you very much. Next panel. Is the panel PACE administrators. We have Ari Matsuziak, Cliff Stanton, and Mike Lemire. Lemire. Welcome, gentlemen. And again, if we could keep our comments to 5 minutes, we're about an hour overtime right now. And we have you and another panel to go.
Great. Well, thank you. Is this on? Okay.
Yes.
Chairwoman Eggman, Chairman DeBobney, Vice Chairman, and members of the committee, thank you for the time. My name is Arvin Tuziak. I'm Executive Vice President at Renovate America, and I would like to thank you for the opportunity to testify this afternoon on AB 2693. Renovate America is headquartered in San Diego. We're the leading provider of financing for energy and water efficiency home improvements in the United States. Our HERO program provides local governments with a comprehensive PACE financing solution that's defined by its consumer protections and our technology platform that enables homeowners, contractors, and local governments alike to gain access to what has become an incredibly important public policy measure. I'd like to step back a little bit and provide some context that I think is helpful for this conversation. As a country, we've made significant progress to diversify our energy sources and reduce reliance on fuels that produce the emissions that cause climate change. The progress has come from technological innovation, policy changes, and innovative private sector responses to those policies. But through it all, we've left savings and opportunity in the residential sector on the table. We estimate that every year, 1 in 6 homeowners makes a property improvement that impacts their energy or water consumption. And yet, of that pool, 75% of those homeowners choose the least efficient measure among the options that they have available to them. That is the definition of a market failure. And it's one that the housing finance sector has failed to address for decades. It's certainly not due to a lack of interest or effort, as you heard earlier today. There's a shared understanding and a broad acknowledgement both that investing in higher quality, higher efficiency, and renewable energy products improves the infrastructure of our residential housing sector and increases the underlying value of the collateral. The problem has simply been that the financing options historically offered in the market don't meet homeowners where they are, and therefore don't work. And so the cycle of suboptimal investment continues. The state of California, frankly, you stepped in to do something about that when you created PACE. You created a financing product rooted in local government, public-private partnership, and sound policy. You created a solution that is working and that is actually a model for the rest of the United States. In 2010, you heard from the FHFA that energy efficiency was a goal, but that PACE assessments could not exist in conjunction with Fannie and Freddie-backed mortgages in a priority lien position. Instead of backing down from addressing this market failure, Governor Brown and this legislature stepped up again, creating the Loan Loss Reserve Fund that you've heard about, to give communities and lenders alike the comfort and security they needed to move forward. And subsequent to that point, over 400 communities covering almost all the state of California have done so. PACE providers like my company, Renovate America, have also stepped up, providing tools to automate the process and create an informed contractor network and provide ongoing support and protections for homeowners. Further, we stepped up with solutions, developing the contractual subordination model, subordinating our rights to the GSEs and other mortgage lenders, and creating a team of experts in real estate to work with homeowners and their agents in the buying and selling process. The results have been dramatic. Our program is the largest player in the residential PACE marketplace. We have improved nearly 65,000 homes across the state of California, saving almost 10 terawatt hours of energy and 4.4 billion gallons of water, reducing emissions by 2.6 million tons, and creating 13,000 local clean energy jobs and more than $2.5 billion in local economic development. We created a new asset class with these bonds, bringing in more than $1.5 billion in private capital to local communities at virtually no taxpayer expense. As an industry working with our bond issuers and local government partners, we've developed a suite of consumer protections that far exceed other financing options in the marketplace for home improvement. Just want to mention a couple of those. We do not provide payment to contractors until the homeowner signs off that they are satisfied with the work that has been completed and that the job has been done well. We voluntarily created a disclosure form modeled after the Consumer Financial Protection Bureau's Know Before You Owe form, not because the CFPB told us to, but because we believe the idea of presenting consumers with all the information they need in a simple and understandable way that will come to be instantly recognizable. Also, we at Renovate America require a separate confirmation of terms call for our customers to verify that they understand what they're signing. We have executed hundreds of subordination contracts to preserve the interest of the primary mortgage lender. And our industry organization, Pace Nation, has adopted a set of consumer protection standards to apply to all industry players in California and across the country. In short, PACE is still flourishing in California, and California is still on the way for being the model for the rest of the country and, frankly, the world of how to make widespread what is still too rare, achieving a win-win of renovating one's home to maximize energy and water efficiency to help save our climate and hard-earned dollars of working families. Indeed, in the last 18 months, President Obama has made this part of one of his priorities as he closes out his administration, spreading residential PACE across the country. In recognition how we have collectively stepped up to work together to solve this market failure, the President and the FHA both have announced support of PACE as a critical tool to meet the nation's clean energy goal, and the FHA has indicated that guidance for subordinated PACE is imminent. We've consistently shown our commitment to work together to find and define a PACE product that works for everyone, for the environment, for the homeowner, for regulators, and the economy at large. We are committed to that. That is why we support enshrining into law disclosure and consumer protections that are the intent of AB 2693. But make no mistake about it, rather than show the same commitment, others with more narrow interests have sought to ensure that every iteration of the bill to date seems aimed at hurting PACE and steering California homeowners away from it. From the actual impact of suggested provisions.
This really isn't about the bill today. This is about
overall.
So we would like to keep it to that in good faith, and I don't appreciate that. So
okay. The arguments that opponents have made to the industry are not rooted in broad-based fact, and the wild claims that have been made about how PACE will cause a housing crisis that tears down our economy are not founded. The housing crisis was not created by those seeking to do home energy renovations to reduce the consumption of energy and water. That is just true. And there are facts to also consider. The default rate for PACE homes in California is less than half of the rate of California as a whole. Indeed, of the almost 65,000 homes that we have financed through HERO, there have been 21 bank-initiated foreclosures out of 65,000. PACE improvements have been demonstrated in a study by one of our nation's foremost housing finance experts, Lori Goodman, and Chairwoman, you referenced the Journal of Structured Finance report that's in your handouts, and which is a peer-reviewed study. PACE improvements have been shown to fully recover the cost of the investment and either maintain or add to the value, to the resale value of the home. Comparatively, Goodman cites in her report that recent studies showing kitchen remodels and bathroom remodels recovering only 58 to 66% of the investment at the time of resale. The majority of PACE assessments provide often the only viable source of financing for systems and products that have failed badly or needed to upgrade. 50% of our homeowners come to us when something has broken and they are making a non-discretionary unplanned purchase. The oversight of individual projects and homeowner complaints is done at a local government level, which you have heard a bit earlier today, providing customer satisfaction, which banking regulators could never provide. And finally, the PACE industry as a whole represents less than 0.1% of the California housing market and less than 1/100% of the nation's housing market overall. PACE homes are not a threat to the broader economy. They are a small but growing sign of the vitality of our housing sector. There are underwriting criteria that we adhere to. We are strict and focused on ensuring that homeowners are taking on obligations that make sense, and we are focused on scoping down to the narrow form of financing which is rooted in energy efficient, water conserving, and renewable energy products, all of them certified by the U.S. Department of Energy, the U.S. Environmental Protection Agency, or the state of California government. Renovate America and others in the residential PACE community will continue to work to solve legitimate issues raised by anyone in the regulatory or housing industry who respects the importance of having an affordable and viable PACE option for homeowners. We are committed to that. We are eager and have indicated multiple times our willingness to work with all of you on that solution. Respectfully, we would submit that the primary guideline for any PACE legislation should be the Hippocratic Oath, to first do no harm. The current conversation around and contributions to the legislative conversation do harm, which we believe these communities and esteemed chambers do not intend. In closing, we stand ready as an industry to work with you and your colleagues to make PACE law the model for the nation that it is becoming in practice. Thank you for your attention and diligence to get the policy right.
Thank you. Mr. Stanton?
Hi. So my name is Cliff Staten. It's actually a typo in the name. I'm the Executive Vice President of Renew Financial. And Renew Financial was founded in 2008 by Cisco DeVries, who was then working for the mayor of Berkeley and came up with the idea of PACE. And then he left the city of Berkeley to start Renew Financial so that we could finance and administer PACE programs on behalf of local governments. I was one of the first employees hired by Cisco, and like him, I spent my career working with local, state, and federal governments. And now we have a company that has 270 employees. We have offices in Oakland and Roseville. We administer the California First program, which is on behalf of CSCDA, who you heard from earlier, and also Los Angeles County. We now work with 363 local governments around the state and provide financing for about 82% of the state's homeowners. I answered most of the questions I think that you posed as a committee in written documents, so I just want to briefly describe what our relationship is with the local governments that we serve. So with LA County put out an RFP in 2014. They selected 2 administrators to run their program in Los Angeles County. They selected Renew Financial and Renovate America. And so we work in contract with the county in all cities within the county. So there are 88 cities in the county, and we work in the unincorporated and all the incorporated cities. We have one other contract is with CSCDA, and so we work for about 250, 60 governments with them all throughout the state. Because of our roots in government, we've always emphasized the public part of the public-private partnership. We proactively developed a robust set of consumer protections that are far superior to other types of financing. Ari talked about them. We've actually worked in collaboration with both CSCDA, LA County, WRCOG, Sandbag, and now PACE Nation has adopted the same set of consumer protections. And a few of them are every contractor must be licensed and bonded. They must be trained in how to sell PACE to their customers. And they have to agree to abide by the terms of our program agreement. They all have to pull all the necessary permits and verify that the job is permitted appropriately. We'll only finance those projects that are eligible and that have been approved by state or federal energy or water agencies as eligible projects. And as a consumer protection for seniors, we place outbound calls to every senior, every person over the age of 64, to ensure that they understand exactly what they're financing and what the terms of the financing are. And I want to emphasize that we developed all of these protections in collaboration with our local government partners, not as a part of a government mandate. And they don't exist. I mean, that's one of the slides that I sent in to you, is comparing how PACE consumer protections compare with other financial products, home equity line of credit, credit card, cash, however else you might pay for this. And none of those other financial instruments provide that same level of protection. There was a question raised by the chair about whether PACE needs additional regulation, and I welcome the conversation. I tell our folks at Renew Financial that, we don't have one regulator, we have 363 regulators. Every single local government is somebody that we have a responsibility to. And in fact, I would argue that being overseen by local government is a much more rigorous form of regulation than anything the banking or real estate industries face. If a homeowner has a problem with their contractor, has a complaint about their HVAC or whether their roof was leaking, they can call us. We're available 7 days a week. And if they don't get us and they don't get satisfaction, they can call their local government, and they do. And I think most of you all have served on city councils or county boards of supervisors, and what it's like when your constituents have problems. They'll grab you on the street. They'll find you in a restaurant when you're eating. They'll talk to you at a community meeting or when you're going to church. They will find you if there is a problem. And you know from your own experience, there's nothing so close and personal as local government. And if there are problems with a PACE provider, all the local government has to do is opt out of the program. We have 2 contracts. All these other local governments simply opt in. They don't have to terminate a contract. They don't have to sign anything. All they have to do is put on a council agenda and opt out. And so we take our consumer protection policies seriously, not only because it's the right thing to do, because it's the only way that we can stay in business. I also want to point out that when mortgage lenders were irresponsibly giving out no-doc loans leading up to the mortgage crisis, it wasn't nearly so easy for a community to protect itself.
I don't know what that's relevant to. Can we stick to topic?
Well, I think since there have been allegations about unscrupulous lending practices, I do think, and that this exact analogy has been made in these hearings, I do think it's relevant. In fact, I mean, what we've heard
the contractors
is that
I think we said there's unscrupulous contractors that engaged in overselling or overpromising or misleading. And I think Wygren's very aware of this, considering they were subject to a video on a local newscast and admitted error and said they would rectify the situation. I don't know if anyone said anything about unscrupulous lending, so I think we should be very clear on that, and I'll stick to the point. And if we need to play the video for you guys, we can do that. But I think I forget your name, I'm sorry, but from Wygren here was very, I think, kind to the people that came up and testified. They clearly experienced an unscrupulous contractor that was associated with the company at question who misled and committed fraud against these unsuspecting seniors who were put in a very bad position with the purchase of the home efficiency products that obviously provide some benefit, but not to the level what they were promised. And I don't think we need to rehash that. And I don't know if anyone here has any further question on that, but I don't think there was ever a point made that there was unscrupulous lending going on.
I think there has been a comparison between the PACE industry and the mortgage meltdown. And my point
I
is
think
that
the
communities have a way to
comparison
protect
is
themselves.
the comparison is that both require some type of situation where you have now a lien priority. The mortgage now is being secondary. I mean, if we want to have a conversation over the nature of what it means to take out a mortgage, comparing that to this, then maybe we should make this industry take out the same type of underwriting standards that a mortgage does. If you want to have that comparison, we can do that.
Well, I guess let me just, instead of going where you're headed, close with this. I think Mr. Pollard came and talked about lien priority, which is really FHFA's issue. And what this conversation gets often confused about is whether this is a loan or an assessment. And the fact is, PACE is based in, as Janine said, a 100-year-old law, 1911 Bond Act, that provides local governments the ability to tax their residents. And that is why Attorney General Jerry Brown sued the federal government, was in order to protect the rights of local governments in California to exercise that right. And I think there are these 2 issues. There is lien priority, and the state of California has been in a fight with FHFA about this and set up a PACE reserve in order to satisfy FHFA's concerns and also around lien priority. And I think, as we've seen, there has not been one claim made on that reserve yet. So there is not evidence from the record that there is a problem on the lien priority issue. And I think that the other issue, which I think, as you've pointed out, needs addressing is consumer protection. I've told you how we've addressed that with all of our local government partners, and we're happy to have that conversation with you and with the committee. Is there a better or different way to regulate? What we've tried to do is develop not only a new industry, but also a one that has robust consumer protections through the local governments that have the taxing authority for PACE. And if you think that the state needs to have a different role, I'm happy to have that conversation. We've been here working as good faith partners for 8 years now on this and want to continue to do so. I'll just leave it at that.
In the way that the program was designed, you feel like you've been a good and honest partner and are here to share your experience with us. Okay, Mr. Layton.